America's national debt has become one of the biggest issues in global finance. Interest payments are now one of the largest government expenses, outpacing spending on defense and education. For decades, the U.S. has spent far more than it earned, yet it continues to borrow easily. Why? Because the U.S. dollar is the world's reserve currency. The dollar-AS dominance gives America a unique power. It can issue debt in its own currency, and the world accepts it. Still, even the world's richest nation faces consequences. The U.S. now holds the highest nominal debt in human history. Economists warn that every borrowed dollar is a promise to future generations, a promise that grows heavier with each passing day. But while the world debates America's debt, few realize that China's situation is far more dangerous and 3 times bigger. China's total debt, including government, corporate, and household borrowing, is now over 300% of its GDP. It's a shadow mountain of money built to fuel decades of growth. Unlike the U.S., China's debt isn't primarily held by the central government. Instead, it's hidden in a complex web of local governments, state-owned companies, and private firms. This makes it far more difficult to track, manage, and ultimately, to solve. The story of China's debt began with its economic miracle. To build modern cities and high-speed rail lines overnight, local governments were encouraged to borrow heavily. They created thousands of special financing vehicles, or LGFVs, to fund these massive projects. These entities borrowed from state-owned banks, creating a closed loop where money flowed from one government pocket to another. For a while, this system worked spectacularly. Growth was explosive and China became the world's factory. But this growth came at a staggering cost. Many of these projects, like the infamous ghost cities, were built not because of genuine demand, but to meet GDP targets. Now, these empty apartment blocks and deserted shopping malls generate no income. The loans used to build them, however, are still due. This is the core of China's problem, a mountain of non-productive debt. The money was spent, but the economic value was never created. Think of it this way. U.S. debt is like a credit card bill from a wealthy individual with a stable, high-paying job. It's huge, and the interest is a concern, but the ability to pay it back is backed by the world's largest economy. China's debt, on the other hand, is like a series of off-the-books loans taken by different family members to build extensions on a house that nobody lives in. The total amount is astronomical, and the assets backing it are questionable. This brings us to the corporate sector, which holds the largest slice of China's debt pie. Many of the country's biggest companies are state-owned enterprises, or SOEs. These giants operate in key sectors like energy, steel, and construction. They have long benefited from easy access to cheap loans from state banks, often regardless of their profitability. This has created zombie companies, firms that are effectively bankrupt but are kept alive by continuous infusions of new debt. They don't innovate or grow, they just survive, consuming capital that could be used more productively elsewhere. And then there's the property crisis, the most visible symptom of China's debt disease. For decades, real estate was the safest investment for ordinary Chinese citizens. A booming market fueled a construction frenzy. Companies like Evergrande and Country Garden borrowed billions to build vast residential complexes. But the bubble has burst. Home sales have plummeted, prices are falling, and these developers are now defaulting on their debts, leaving behind a trail of unfinished apartments and angry homebuyers. This isn't just a financial crisis, it's a social one, shaking the trust of the middle class in the government's economic stewardship. So, why is China's debt more dangerous than America's? It comes down to 3 key factors: transparency, currency, and control. First, transparency. U.S. debt is public knowledge, debated openly in Congress and scrutinized by global markets. China's debt is opaque, hidden within thousands of different entities, making its true scale and risk impossible to accurately assess. This lack of transparency means a crisis could erupt with little warning. Second, Currency. The U.S. borrows in its own currency, the dollar, which the world needs. This gives the Federal Reserve incredible flexibility to manage the debt. China's currency, the yuan, is not fully convertible and lacks the trust of international investors. If a crisis hits, China cannot simply print its way out without risking capital flight and a currency collapse. It has to rely on its foreign exchange reserves, a finite resource. Finally, control. While the U.S. system is chaotic, with political gridlock often threatening defaults, it is also decentralized. A problem in one sector doesn't automatically cascade into another. In China, the state is intertwined with every aspect of the economy, and this allows for decisive action, but it also means that a failure in one area, like property, can quickly destabilize the entire state-controlled banking system. The risk is systemic and concentrated. As China's economy slows, the cracks in this debt-fueled model are becoming impossible to ignore. The government faces an impossible choice: continue to pump credit into the system to maintain growth, risking an even bigger debt bubble, or allow for defaults and restructuring, which could trigger a painful recession and social unrest. For years, the world has bet on China's seemingly unstoppable growth. But beneath the gleaming skyscrapers and bustling factories lies a foundation of debt that is looking increasingly unstable. The U.S. has a massive, well-documented debt problem. It's a challenge that will define its economic future. But China is facing something far more complex and perilous: a systemic debt crisis hidden in plain sight. Its resolution, or lack thereof, will not only determine the fate of 1.4 billion people, but could also send shockwaves through the entire global financial system. Unlike the United States, China's debt isn't backed by the world's reserve currency. Its credit rating sits at a solid, but not stellar, A+. This reflects a higher level of perceived risk and, consequently, less absolute investor confidence compared to the rock-solid rating of the U.S. So, what does this actually mean? Well, for starters, China's government can't borrow money as cheaply as the United States, and that's just the tip of the iceberg. The real challenge lies in the vast, almost labyrinthine network of local government and corporate debts. These are often much harder to track, cleverly hidden within complex financial structures and off-balance sheet vehicles. Think about it. Decades of unprecedented breakneck urbanization have fueled this mountain of debt. Cities sprouted from empty fields, and skyscrapers pierced the clouds. Real estate, which for so long was the shining symbol of China's economic miracle, has now morphed into its greatest potential risk. We've all heard the stories of ghost cities and seen the headlines about struggling giants like Evergrande. These aren't just isolated incidents, they're symptoms of a systemic issue. The model of borrowing to build, which worked for so long, is now showing deep structural cracks. Now, why should you, sitting thousands of miles away, care about this? Because if China's massive debt bubble were to burst, the shockwaves wouldn't stop at Beijing's borders. It would create a tsunami that ripples across the entire global economy. Think about the supply chains we all depend on. The flow of raw materials from countries that supply China's industrial machine, and the stability of global trade itself. Everything is connected. A downturn in China would mean a downturn for a significant portion of the world. From the ports in Rotterdam to the stock tickers on Wall Street, everyone would feel the impact. As we look at the bigger picture, a stark contrast emerges. The United States borrows because, as the holder of the world's reserve currency, it can. It has the unparalleled power and financial flexibility to do so. China, on the other hand, borrows because it feels it must. It's under immense pressure to maintain growth, create jobs, and sustain social stability. In a way, both nations are trapped in a cycle of debt, one by the privileges of its power, the other by the pressures of its ambitions. Ultimately, we are left with a sobering reality. The next global crisis might not begin in a bank or on a trading floor, but with the silent, creeping weight of sovereign debt. The numbers are staggering. but they boil down to one fundamental question that affects every single one of us. How long can the world keep borrowing from its future before the bill finally comes due? Thanks for watching. If this video gave you a new perspective, don't forget to like, subscribe, and hit that notification bell to stay updated on our deep dives into the global economy. See you in the next one.